Today, we are looking at Meta Platforms, a stock that is genuinely fighting on two fronts at once right now. On one side, an enormous AI spending bet. On the other, a federal trial that opened just days ago with a potential penalty large enough to matter even for a company this size. Edward, let us start with the business itself before we get into the courtroom.
The underlying numbers are still strong. Q2 2026 revenue came in at $61 billion, up 28% year-over-year, powered by advertising. But operating margin compressed from 43% down to 31%, as costs jumped 55% to $42 billion. Free cash flow fell 91% to just $784 million, almost entirely because of AI capital spending. Zuckerberg has raised 2026 capex guidance to as much as $145 billion, up from $72 billion in 2025, nearly double.
Now the part that is genuinely dominating headlines this week. Walk us through this trial.
A federal child safety trial opened on August 18th in Oakland. 4 states, California, Colorado, Kentucky, and New Jersey, are arguing Meta deliberately designed Facebook and Instagram to be addictive to children and misled the public about the harm. State lawyers have told the judge they are seeking around $200 billion in penalties. Meta itself, in a court filing, cited a state calculation reaching as high as $1.4 trillion, nearly Meta's entire market cap, though legal experts have publicly cast doubt on that number ever being reached. The trial is expected to run about 6 weeks, and Zuckerberg himself may testify.
That is an enormous range, 200 billion to 1.4 trillion. Why so wide?
Because nobody actually knows yet. And that uncertainty is exactly what markets dislike most. This is also not Meta's first loss on this theme. A New Mexico jury already ordered Meta to pay $375 million in March over child safety failures, and a judge added another $567 million more recently. Legal analysts have called this Oakland case social media's, quote, big tobacco moment, a precedent-setting theory that could also extend to other platforms facing similar suits, like TikTok and YouTube.
How has the stock actually reacted to all this?
Meta is down about 17% year-to-date, despite that 28% revenue growth, so a lot of this legal and spending anxiety is already reflected in the price to some degree. Interestingly, shares are trading around $549 right now, still well off the 52-week high near $791, but analysts have not abandoned the stock. Bernstein reiterated a buy with an $800 target just as the trial opened, and BNP set an $855 target, citing the AI compute opportunity. The average analyst target sits around $754, with a strong buy consensus.
With all this legal noise, is the stock actually cheap right now?
By one measure, yes. Meta's forward PE is around 17, below its own 5-year average, and well below the broader technology sector. Some analysts are explicitly calling this a bargain in disguise setup, where sharp pessimism around the trial and the capex has pushed the valuation down faster than the underlying advertising business has actually deteriorated. That is the core tension of this stock right now.
So what is the bull case if this settles reasonably and the AI bet pays off?
AI-powered advertising is already showing results. Higher price per ad and steady impression growth suggest the machine learning investment is working inside the core business. If a settlement lands well below the $200 billion headline number, which is what most legal observers expect, given how these cases typically resolve, the market could treat that as a relief event rather than a disaster. And if Zuckerberg's broader AI investments create new revenue streams beyond advertising, that changes the long-term growth story entirely.
And the bear case?
You are holding a company spending up to $145 billion a year, with free cash flow down 91%, an unresolved legal case that management itself has floated at trillion-dollar exposure in court filings, and a 6-week trial that will keep generating negative headlines regardless of the eventual outcome. Even a moderate settlement still means a real cash outflow on top of the heaviest capex year in company history. James, as an investor, does a forward PE of 17 feel like compensation for that level of uncertainty, Or does it feel like the market simply has not caught up yet?
Honestly, it feels like the market is waiting for the jury before it decides which number is right.
Retail investors tend to react to trial headlines directly. A bad day of testimony can move the stock several percent either way. Institutions are more focused on the base rate. Precedent-setting cases like this typically settle for a fraction of the headline ask, and Meta has the balance sheet to absorb even a large one-time penalty without threatening the core business. The 3.6 billion daily users and the advertising engine underneath all of this has not gone anywhere.
What are retail investors missing here versus institutions?
Interest rate expectations still weigh on high capex technology names broadly, and this Oakland trial has industry-wide implications. A state win could become a template used against other platforms, which is why legal observers are watching this well beyond just Meta's own stock.
Anything on the macro side worth flagging?
Based on our internal scoring framework, educational only, not a stock recommendation. Revenue growth, 8 out of 10. 28% year-over-year is strong, even as it decelerates slightly. Balance sheet, 7 out of 10. Still solid, but free cash flow down 91% this year is a real number to watch. Moat, 9 out of 10. 3.6 billion daily users across the family of apps remains an extraordinary network effect. Valuation discipline, 7 out of 10. A forward PE of 17, below the 5-year average, is genuinely attractive on its own. Red flag load, 4 out of 10. An active federal trial with a stated exposure range up to $1.4 trillion, layered on top of record capex, is a meaningfully elevated risk profile right now. Total CF Global Stock Score for Meta, 35 out of 50. Overall status, watch carefully.
Now, the CF Global Stock Score for Meta.
And amid all this, do not forget the most important investment of all, enjoying the beauty of life.
35 out of 50. A real business with real legal uncertainty sitting right on top of it. We are sure a score like this helps you separate the headline noise from the underlying picture, rather than reacting to every trial update. Before we close, drop a comment below with the stocks you would like us to score next. If enough of you request the same name, we will cover it in a future episode. No AI, invest in AI. See you next episode.